Hello, class, and welcome to our 14th lecture series on international finance. And I'm your instructor, Jamal Haider. Okay, let's begin. So we have planned our exam going to be on 29th of December, and the timing is we are planning to have 2 hours paper from 9:30 p.m. to 11:30 p.m., not a.m. Okay, I'm so sorry. We need to change that. That is p.m. Okay. Okay, so regarding our quick review, let's have a quick review on our next slide. Regarding our quick review, we were discussing the international arbitrage, and what are that? It is defined as capitalizing on the discrepancies or differences in the quoted prices by making risk less profit, 0% risk. So remember, the profit rule is higher the risk, higher the profit, right? So in order to capture this higher profit, you need to depend on the size of investment. So in this case, riskless profit, there is no risk. So how can you make big profit? According to the size of the investment, right? So we have three arbitrages: locational arbitrage, triangular arbitrage, and covered interest arbitrage. So locational arbitrage, we discussed that it is the process of buying a currency at the location where it is priced low or cheap and immediately selling it to another location where it is priced higher. So remember, you need to remember the profit rule, that is buy low, sell high. That is the rule here. So here we go. In this situation, we already talked about that. So how you can make profit? So buy means if you want to buy, then you need to look for ask rate. Why? Because bid and ask is dealer's perspective. You want to buy, it means dealer want to sell. So similarly, you will buy from Northern Bank at 6.40, and when you want to sell, bank will buy, and you will sell it at so you would be having $0.005. So how much profit you're gonna make depends on the size. Of course, if you invest $1,000, profit gonna be lower. If you would be investing 1 million, of course, profit gonna be, the size of the profit gonna be higher. And then we talk about amazing stuff, that is triangular arbitrage, which is as the currency transactions in the spot market to capitalize on the discrepancies in the cross exchange rate between two currencies. We talked about that. So the rule is if a quoted exchange rate differs from the appropriate cross exchange rate, you can attempt to capitalize on the discrepancy. Specifically, you can use triangular arbitrage, right? First of all, convert your home currency into some other currency, for example, some other foreign currency, to another foreign currency, and then back to dollar, your home currency, right? If the question is silent, so remember where you are, because this book is US centric. Okay, then we talk about the triangular arbitrage. We talk about this example as well, in which we talk about that, okay, the British pound is giving you $1.60, Malaysian ringgit is 0.20, and the exchange rate is 8.1, in which we talk about, okay, there is arbitrage. How? Because when we convert our cross exchange rate, what we find out that it is how much? Let's calculate that. So British pound We can calculate this. So dollar over pound, we have 1.60. And then Malaysian ringgit over dollar, this is dollar over Malaysian ringgit, right? So our cross exchange rate is different, this cross exchange rate is different. So it means there is discrepancies. How? It should be 8, but in the market this is 8.1. It means there is an opportunity. So how we can do that? You sell your dollars, so, or the appropriate word is convert your dollar into pound and pound into Malaysian ringgit and then convert back into dollar. So if you make this a triangle, it looks like that. Dollar into pound into Malaysian ringgit and again dollar, right? Let me just erase it. There we go. And then the last one is the covered interest arbitrage, which is capitalizing on the interest rate differential between two countries while covering your risk, because arbitrage means risk less profit. So if you just find out the covered interest, if this is uncovered, which means you are not covering your position, you're covering your risk, then that is not arbitrage. Why? Because arbitrage means risk less profit. So first of all, you capitalize on interest rate and then you cover your risk through some kind of hedging or forward contract. Okay. So now the comparison of arbitrage. We already know the three types of arbitrage: locational, triangular, and covered interest. So the comparison between these, the threat of locational arbitrage ensure that the quoted exchange rates are similar across banks in different locations. So if there is a locational arbitrage, so people exploit it. The analysts, the currency dealers, they want to have this riskless profit, they would exploit that. Eventually, when bank knows, they will try to eliminate this kind of arbitrage. So what basically they are trying to say, the arbitrage exists, yes, but arbitrage make the market again in equilibrium so that everywhere the rate is similar. The threat of triangular arbitrage ensures the cross exchange rates are properly set. If there is a difference between cross exchange rate that we just looked in our previous example here, we find out it should be 8, but in the market it is 8.1. So people start exploiting this opportunity. And what happened until the rate goes down to 8? So triangular arbitrage also work through market efficiency or market equilibrium so that there is only one price or one quoted exchange rate throughout the market. The threat of covered interest arbitrage ensures that the forward exchange rates are properly set, right? So according to IFE, what we learned that if a country has higher interest rate, according to IFE, what does it mean? It means in country A, there is high inflation as well, and its currency should go down, right? According to interest rate parity, it says that high interest rate means the high interest rate mean all the money will go to country A, right? And the difference is the premium. 1 plus interest home, 1 plus interest in foreign minus 1. This is the forward, right? When this happens, forward rate will increase or decrease accordingly. So if that scenario happens, so it ensures that the difference should also increase, the premium should also increase. If premium is not increased, before the premium is increased, if you covered your position buying forward, you are in good position. Otherwise, the forward start selling at a very expensive, and you will be ended up the same 5%. Okay? The IFE, make sure that wherever you are better off investing in your own place rather than investing somewhere else. Why? Because then the differences in interest rate is adjusted through inflation, and inflation should be reflected in your exchange rate. And eventually you are ended up earning the same rate that you can earn in your home country. That's it. Let me just erase all the mess here. Here we go. Number 4, the arbitrage tends to allow for more orderly foreign exchange market so that there is no glitches, there is no loopholes, there is no, temporary disturbance or differentials in the market, right? So whether this is the locational, triangular, or covered interest, all types of arbitrage push the market into equilibrium so that they can run smoothly, or they can make sure that everything is running in an order. So here we go, we have exhibit from your book 7.8, which shows that location arbitrage is basically exploiting the locations.